Hi, I'm Bob Benson, Chief Investment Officer at Laird Norton Tyee. Thank you for joining us for our quarterly outlook. What I wanted to cover today was a little bit about what happened in the third quarter, the Fed's actions, and our anticipation of what that would entail for the economy and the capital markets. And finally, again, tie that all together in terms of what does this mean for our clients' portfolios, our outlook, and how does this actually impact how the rubber meets the road in our client investments, helping our clients achieve their investment goals. So quickly looking at the third quarter, the performance was very much in line in terms of riskier assets, assets with greater volatility levels tended to significantly outperform less volatile, safer assets. We saw investment grade fixed income, as measured by the Barclays Aggregate Index, return about 1.5% for the quarter. Not bad for the quarter, but if you move all the way to the other end of the spectrum in terms of emerging markets, they generated about 8% return. Commodities generated nearly a 10% return, with domestic and international developed equities falling in between. But it was pretty much a straight line across. The more risk an investor was willing to take, the greater the reward that they received in the third quarter. It's not unusual that as you take more risk, you tend to get greater reward, but it wasn't driven by strong economic news. Investors were not rewarded for taking risk in the third quarter because the economy got better, because earnings got better. In fact, earnings got worse. And globally, as well as domestically, the economy seemed to get worse. What we saw was instead the Fed's actions, as well as other central banks. The Fed initiated what is known as Quantitative Easing 3, or QE3, what many people have now dubbed QE3+, because it's open-ended. Now, for quantitative easing, what the Fed is trying to do is generate additional cash flow into the economy. It does this by purchasing assets, typically bonds. It'll go out into the marketplace, buy the bond, and it leaves the cash behind. Now, it's done this 2 times previous to Quantitative Easing 3+, but this third round is very, very different. Typically, what the Federal Reserve would have done was indicate we're going to buy a certain dollar amount of assets, or they would say we're going to go to a certain calendar date. For Quantitative Easing 3+, they did neither of these. In fact, it's very open-ended. In addition to the $45 or so billion they still have to buy for Quantitative Easing 2 to complete that through the end of this year, they are promising to buy $40 billion with a B dollars, every month of mortgage-backed securities, essentially mortgage-backed bonds. Their goal here is couple-fold. First, to keep interest rates very low. We anticipate they'll probably be successful at this. I don't see interest rates falling a whole lot from where they are now. They're still pretty close to record lows. Historically, they're in very, very low levels. But we see more this as a stabilization. It's not going to let interest rates rise in the near term. But part of the goal also is that by putting more money into the economy, the Federal Reserve hopes that they can stimulate greater economic growth. As I said, in the third quarter, both on the global economy as well as on the domestic economy, we didn't get positive news. In fact, overall, we got negative news. We got earnings slowing down. We got GDP slowing down in the US and China, India. China and India, which had been running at their peak in the recovery at about 11%, slowed down to about 7.5%, 5.5%, respectively, in the last available data. We saw exports from the US, which had been a critical component of our recovery to date, begin to pull back as the global economy slowed down. So moving forward, what do we expect to see from Quantitative Easing 3? It's very aggressive. The Fed is going all out with this one. And we expect to see some fairly significant changes in the capital markets, less significant changes in the economy. What I mean by that is that if you look at the risk spectrum that we saw in the third quarter, investment grade moving out to high yield, moving out to equities, and so on out to commodities and emerging markets on the risk spectrum, investors were well compensated for the risk moving out there. Quantitative easing tends to promote that kind of return for the risk. It tends to drive investors away from safer assets, investors that typically have to live on their income generated by their portfolio, or that need to meet a certain return requirement. As rates fall and stay low, those investors simply can't meet their investment needs and objectives by staying in a relatively conservative, largely fixed income portfolio. They have to step out of their comfort zone. They have to increase the risk. As they do that, it improves the return that investors will get for risk, assuming that everything continues to go well. Now, what I mean by going well is that the economy will continue to at least muddle along. It won't hit a recession. It's unlikely, in our opinion, that the economy will hit a recession. I'll talk on that a little bit more. But we do see that quantitative easing 3+ or QE 3+ by the Fed is going to help encourage investors that are reliant upon their income or reliant upon the living off the return of their investments to move out in the risk spectrum, to move out into riskier and riskier assets. But overall, that's not happening in the economy as a whole. In fact, what we're seeing is a lot of investors, a lot of households, a lot of corporations, a lot of lending institutions pulling back and doing less and holding on to more cash. We saw the amount of cash in savings accounts, which in today's market environment are earning investors essentially a zero return. We saw that increase by 5% through the spring of this year. Investors are not doing that to chase yields. Investors are doing that because they're concerned about the future. Adding more cash to a very, very liquid economy is probably not going to drive economic growth. The idea behind the Fed engaging in quantitative easing 3+ is to promote economic activity. Economic activity will thus drive hiring, and we can move a little bit further along, start generating jobs in the economy. We see some positive and mixed signals regarding unemployment for a month or so, initial jobless claims for a week or two, and that tends to pull back. We've also seen some benefits or some green shoots in the housing market. This is our third time now of seeing some green shoots in the housing market. The other two times we really haven't seen the housing market take off. Housing market is very cyclical in nature. It tends to do very poorly through the recession and recover very quickly and robustly following the recession. We didn't see that recovery this time. Part of what the Fed is doing by buying the mortgage-backed securities is trying to keep those mortgage rates very, very low. Thus far, they've been successful. At the end of the recession, or excuse me, before quantitative easing 3, the Federal Reserve started adding money at that point, buying some mortgage-backed securities in quantitative easing 2. They have now added about $2 trillion to the U.S. economy, $2 trillion more in the marketplace than what we had experienced before the recession. They brought the 30-year fixed mortgage rate from a little bit more than 6 to down a little bit less than about 3.4%. Now, that's a significant decrease, almost a 50% cut in the mortgage rate, but we haven't seen new mortgages come online. Part of that is the willingness of lenders to lend. Part of that is just the desire of Americans to start new households, to stop renting, move out of their parents' home, move out of roommates situations, and actually go buy their first home. And it's very stimulative to the economy when households are formed, because when you buy the home, you get the furniture, you tend to get carpet, you get the TV, you buy more things that your parents already had that you had been using when you had been living in their basement. We're not seeing that kind of strength, and that's really what the Fed is trying to get at. But, as we've seen, mortgage rates, 30-year fixed mortgage rates, fall by roughly 50%, down to about 3.4% now. We've actually seen outstanding mortgages decrease. Not exactly what the Fed is asking for. In fact, the exact opposite of what they're hoping for. Mortgage rates have fallen, people still aren't buying homes. The decrease in outstanding mortgage levels could very well be due to refinancing, taking advantage of the lower rates. Quite a bit of it could be due to foreclosures of homes. What we're not seeing is that opposite side, though. We're not seeing new households being formed as people feel confident enough to invest in a 30-year fixed mortgage on a home. Now, on the economic front, quantitative easing 1, quantitative easing 2 didn't do a whole lot for us. In fact, the economy has been slowing quite a bit. We had a couple of quarters since the recovery, or during the recovery, where we actually topped, just for one quarter at a time, we actually topped the 3% long-run average of GDP. Since then, however, we've been slowing down. In fact, in the first half of this year, we only have data on GDP, or gross domestic product, through the first half of this year. We've actually slowed down. Instead of running at a long-term average of about 3%, instead of spiking up at close to 4% for a quarter or two, we've actually been running now at about 1.6 growth rate. It's not fast enough to generate the job growth that the Fed is looking for. It's not fast enough to generate the positive outlook that new homeowners and new households will be looking for, to take that chance and invest in a house, in a relatively illiquid asset. So what we're seeing here is a greater impact from the Federal Reserve's actions on the capital markets and our expectations for the capital markets moving forward than what we expect to see in the economy overall. We don't anticipate a whole lot of economic prosperity and expansion from the Fed's actions, we do see much more impact on the capital markets. Now looking forward, in terms of our outlook for the future, capital markets, the economies, we continue to see the US economy as well as the global economy continuing to kind of struggle along. Slow profits, difficult times, bumpy profits, and bumpy expansion. And we're not anticipating a sharp increase in the growth rate. Europe is continuing to struggle and going into recession. We're seeing contraction of the United Kingdom's economy, seeing contraction in continental Europe's economy as a whole. We're seeing a significant slowdown, as I said, in Asia and in emerging markets. But overall, the United States, which has to date, again, has been largely fueled by, our expansion has largely been fueled by our exports, we continue to have a fairly stable, solid, not robust, but solid consumer spending. And as the consumers in the United States continue to spend, we can rely on that to provide a bit of a floor for our own domestic economy. So we're not anticipating a recession, but we do have to admit that the likelihood of a recession is increasing over time. We still have the fiscal cliff. We spoke of that at length, or addressed that at length, in a paper in the second quarter of this year. If you're interested, please take a look. It's on our website. We addressed that the fiscal cliff might take about 3.5% to 4.5% off of GDP. It's fairly significant when GDP is only running at about 1.5 to 2 times. So that's a significant decrease. If we don't successfully deal with the fiscal crisis coming up at the end of this calendar year, we will likely go into a recession. Likewise, we've seen a pullback in our export opportunities as the global economy has slowed the pace of expansion. Gross domestic productivity for the global economy has certainly contracted or slowed down. It's still expanding, but it's at a much slower rate. That has had a negative impact on our exports. So if we were to continue to see a deeper recession, a longer recession in Europe, maybe a recession in some emerging markets or some large Asian economies, that too could drive the United States and the global economy into a recessionary phase as well. We don't anticipate that as our base case. We still think that is less likely. Politicians are slow to react. They essentially need a crisis to really get going. But I think this is a crisis. And I don't think anyone is going to look at the math and realize if they don't address the fiscal cliff, it's going to take off 3 to 4% of GDP, and you're not running anywhere near 2% in GDP, is going to be a problem. I think that's going to spur Congress and the White House into action. I hope it will. I hope they actually address this in a meaningful fashion. Because what we need now is to have the money that's already in the economy, that's already circulating through the US economy and the global economy, to actually be put to work. And to do that, we're going to need to start seeing not just monetary stimulus, but fiscal action that will actually encourage investors to invest, homeowners to actually start new households, to move out and expand on that. So looking forward, we anticipate the capital markets, riskier capital markets, are going to get a little bit of a boost relative to fixed income moving forward. That again is just due to the greater liquidity, the Fed buying the bonds, other central banks buying bonds in their respective markets. That's going to keep interest rates low. Those low interest rates will prompt quite a few investors to go further out the risk spectrum, boosting the returns for risky assets. That being said, we have pulled back a little bit over the last couple of quarters in terms of our own risk profile for our clients' portfolios. What we've done is pulled back a little bit by reducing our exposure to European equities and international developed equities overall. We've moved those assets from developed international equities to high yield bonds. Thus far, it's performed pretty much in line with what we anticipated, with high yield bonds returning roughly in line with what European equities have provided investors, but at about a third of the risk. So roughly the same return, third of the risk on that asset class. That's essentially what we're going for. We're also maintaining a slight reduction in the sensitivity to changes in interest rates. Again, interest rates are at very, very low levels. The Federal Reserve's actions, as well as those of other central banks, will likely keep interest rates low for a while. But if there's a pop-up in inflation, if there's a slip in the central bank's buying, we could see interest rates climb up dramatically in a short period of time. So to protect our clients' investments from that, we're maintaining a slightly less exposure to interest rates than what we normally would. So overall, we're seeing more opportunities to better manage, more tightly manage the risk profile in our client portfolios than we're seeing to generate outsized returns. And that's the focus that we're taking. Our overall arching expectations for this environment is that we're going to go through a prolonged period, we're already a few years into this, where we see very strong and very weak markets for equities, housing, and the like, pretty much any risky asset. You'll see a very strong quarter, perhaps a very strong year, followed by a weak quarter or a weak year, and then followed back again by a strong quarter. It tends to oscillate. We saw this following the Great Depression. We saw this in the late 60s through the 70s. These are periods where people were simply uncertain about the future. They tended not to invest in the future. They tended to hoard cash. That's what we're seeing today with record high household levels of cash. Corporate balance sheets have cash, and banks are holding on to a significant level of cash. Everyone across the board seems to be holding more cash now than they had been during the recession. They continue to be very fearful regarding the future outlook. And until we start seeing some progress on the fiscal side, in terms of government spending and in terms of tax revenue increasing, until we start seeing these elements begin to factor through to the end consumers, we're likely going to continue to be in this choppy, essentially violently sideways marketplace. So we're anticipating that moving forward to position our portfolios on our clients' behalf to help them achieve their goals. We are focusing on better managing the risk rather than trying to seek outsized returns. We don't think it's a very conducive environment to that. So thank you very much for joining us. We do have a paper that goes into greater detail this quarter as well. It's available on our website. And if you have any questions after looking at the paper or looking at this video, please feel free to contact us. Thank you.